Welcome and thank you so much for taking some time to join us today. I'm Brent House, a partner, portfolio manager, and financial advisor here at Fortuna Investors. Today I'd like to share something that we at Fortuna are extremely passionate about, and that's our approach to investment management, which we call our Global Enhanced Alpha Suite of Strategies, or GEA. Now, why should this matter to you? Well, at Fortuna, investment management is the cornerstone of what we do. We have a unique and highly differentiated approach to investing, and we hope that by the end of this presentation, you'll understand how that unique approach can benefit you and your family by providing for the opportunity for outsized returns with lower risk relative to more industry standard investment methodologies. With years in the investment management business, my partners and I recognized that investment management had become extremely homogenized. The lion's share of financial advisors and their clients invest in much the same way. And we at Fortuna wanted to provide our clients with an alternative to the industry standard. Through this investment methodology, we seek to provide stronger returns with meaningful downside risk protection through the use of quantitative or systematic methodologies, all with the goal of providing the highest level of return per unit of risk that our clients are willing and able to bear. I hope you enjoy the presentation. Let's get started. Before we dive in, let's take a minute to discuss the topics we'll cover today. The purpose of this presentation is to help you understand how a financial advisor can benefit you, help you understand Fortuna's unique approach to investment management, and finally, how that approach can benefit you. First, we'll provide some background on the value of financial advice and speak to the two primary means of value creation for a financial advisor, which are financial planning and investment management. Next, we'll explore Fortuna's philosophy on investment management. You'll notice a theme throughout our discussion, and that theme is that Fortuna's methodology is highly systematic or rules-based. Much like industry standard index investing, everything we do to manage investments is based on a strict set of rules. Everything can be boiled down to if-then statements. Unlike traditional indexing, however, we've designed our indices to seek outsized returns and mitigate downside risk. To help illustrate this, we'll take you through two examples of traditional indexing rule sets and show how, by tweaking those rules, we can create better portfolios. In the first example, we'll take a look at stock market investing and a commonly known index, the S&P 500. We'll outline the rules used to construct the index and then discuss how we might create a better rule set for investing in stocks. Next, we'll look at complete portfolios and how industry standard asset allocations are created. This will give us a baseline to explore how we might create a better rule set to manage a complete investment portfolio. Finally, we'll wrap by exploring Fortuna's asset management framework, which we call Global Enhanced Alpha, or GEA. Let's get started. First off, let's talk about what a financial advisor should do for you. Advisors create value for clients through two vectors: financial planning and investment management. As financial planners, we help our clients get organized, create a roadmap for their financial future, and seek to optimize all aspects of our clients' financial lives. The process starts with taking stock of where you are. We create a household balance sheet and cash flow statement. We make sure you have the right accounts set up: retirement accounts, taxable accounts, health savings accounts, and that you're optimizing your asset accumulation strategies. Depending on your needs, we can help in a number of ways from here. We help you evaluate your insurance needs, making sure you're neither underinsured nor paying too much for insurance. We evaluate your debt and ensure that you're using leverage optimally. For those nearing retirement, we help you optimize your Social Security and distribution strategies. And we look out for opportunities for substantial tax savings with strategies like Roth conversions and estate planning strategies. We build a financial plan to show clients how different scenarios may play out and create a roadmap for your financial life. Lastly, as planners, we serve as an ongoing sounding board for all matters financial. So that's the planning function of a financial advisor. And at Fortuna, we're highly focused on providing value through comprehensive financial planning. The second function of a financial advisor is as an investment manager, helping you with the process of actually investing your savings. At a minimum, your advisor should help you understand your risk tolerance and how it reflects both the practical implications of risk and your emotional relationship to risk. But the very best advisors don't just help you invest, but seek to help you achieve outsized risk adjusted returns. This means the very highest level of return for each unit of risk that you're willing and able to bear. Investment management is the cornerstone of what we do here at Fortuna, and it's what sets us apart from other financial advisors. As such, the focus of today's presentation will be on investment management, specifically Fortuna's method of investment management, which we call Global Enhanced Alpha. With that backdrop, let's get into the underlying philosophy of our investment methodology. At Fortuna, we have great respect for the investment methods pioneered by those that have come before us and which have withstood the test of time. And index investing is perhaps the most well researched, respected, and widely practiced investment methodology. In creating Global Enhanced Alpha, we took what we feel are the best elements of index investing, that it's completely systematic, diversified across stocks, different asset classes, and low cost, and enhance the process through the use of broader diversification and more thoughtful rules. This matters because enhanced diversification and improved rules offer the potential for lower risk, higher returns, and better financial outcomes. The last point I'd like to make here is that these portfolios are designed to completely replace a liquid stock and bond allocation. Global Enhanced Alpha is a suite of strategies that is 100% managed, meaning that it is adaptable to your individual risk tolerance and goals, and it's built to be the lion's share of your investment portfolio. As a starting point, let's talk a bit about index investing. Indexing has exploded in popularity over the past 2 decades, and rightly so. As commonly understood, index investing is simply investing your assets in funds that own stocks or bonds in a great number of individual companies in hopes of diversifying risk and earning a reasonable rate of return. This table shows a few sample allocations for standard index based portfolios. These particular models come from Charles Schwab, but these types of models are fairly uniform across different firms. Investors pick indices and allocations to suit their risk tolerance. Generally, conservative investors allocate a higher proportion of their assets to bonds, while aggressive investors favor stocks. Generally, the overall portfolio is rebalanced 1 to 4 times a year, and the broad asset allocation shifts over time as the investor's goals change. Let's talk about some of the strengths and weaknesses of index investing. The most powerful aspect of index investing is that when done right, it minimizes the need to make decisions about your portfolio. At Fortuna, we are strong believers in taking the human element out of the equation, and index investing helps to do that. Indexing is also easy to implement, low cost, and if done correctly, it can be very tax efficient. For all the benefits of indexing, there are some substantial weaknesses as well. First, indexing comes with large drawdowns or periods of loss, and sometimes these can last for a long time. Another downside, it's impossible to outperform when you index invest. Index investing is, by its nature, going to receive the average return of the indices an investor chooses, minus fees, so it's impossible to strive for more. But perhaps the biggest flaw when it comes to indexing is the underlying construction of the indices themselves. This is an important fact that many, even in the industry, fail to understand. The underlying indices were never built to seek returns and manage risk. They were built as tracking algorithms by newspapers and data providers. This bears repeating. The common indices that you see in newspapers and on TV, the S&P 500, the Dow Jones Industrial Average, the Barclays Aggregate Bond Index, the MSCI All Country World Index. They were all created by data providers to help people track broad markets. The rule sets underlying these indices were designed to track markets, not to seek strong returns and not to mitigate downside. As an example of that fact, let's start by taking a look at perhaps the most widely quoted and tracked index, the S&P 500. Most people are familiar with the S&P as a proxy for the largest US stocks, and today there are many ways to access low-cost exposure to this index via mutual funds and ETFs. At the end of the day, the S&P 500 is built upon a rule set. Simply put, the S&P is just a list of companies that meet a certain criteria. S&P constituents must be US based companies that are traded on a major exchange, that meet size and liquidity standards, that have positive earnings in the last quarter. The constituents are weighted in the index according to their size, meaning that larger companies will have an outsized influence on the index relative to smaller companies, and the index is rebalanced once a quarter. Digging a bit deeper and thinking about the fundamentals of this index, what can we say about it? First, we can say that it's definitely systematic or rules based. For the most part, we could automate the composition of the index. Just like a recipe in the kitchen, if you know the ingredients and the process to cook a dish, you can cook it with confidence. If you know the underlying rules of your index, you can construct the index automatically. Next, we can say that it's broadly diversified, at least across US stocks. You're going to have exposure to many different companies across many different sectors, so the idiosyncratic risks with regard to individual companies are relatively low. Put another way, you don't need to worry about one or two companies having financial trouble and that significantly impacting your overall investment. And finally, we can say that it's cheap to own given modern financial markets. And if you own the index via an exchange traded fund, the turnover and thus tax consequences should be relatively low. But there are a couple of important things that we cannot say about the index as well. First, it's not static. While turnover isn't high, companies do come and go from the index. Naturally, companies will go through periods where they meet the criteria and are included, and periods where they do not meet the criteria and are not included. Second, and perhaps more important, notice that none of the rules that we showed previously have much to do with risk management or optimizing returns. Remember, these indices were built as broad market trackers, not as investment vehicles. So if the broad market goes south and you're an index investor, you're going down with the market. Obviously, you can diversify across many indices and asset classes, but there's no stop loss to this type of investing. Nothing tactical designed to help you mitigate downside or enhance return. We just looked at index investing as applied to stocks and specifically the S&P 500. But smart investors don't put all their money into a single index. Rather, they'll seek diversification by investing across many indices, each with exposures to different parts of the market. So, an index investor doing things properly will generally select a portfolio of many indices representing many asset classes in order to diversify risk. Let's look at how an index investor might choose many indices to build a more complete portfolio. The data on this chart shows various standard asset allocation models for index investors. These particular models come from Right Capital, which is a financial planning software, but they are very representative of typical asset allocation models used widely in the industry. Again, these models are very uniform, and these models are similar to those that we showed from Charles Schwab a couple of slides ago. Here in this chart, we just show two models: the typical index investing allocation for a balanced investor, or someone who wants to grow their account but isn't willing to take substantial risk, and an allocation for a growth investor, or someone who's willing to take more risk in hopes of earning higher returns. We hear it all the time, how a broadly diversified portfolio of many indices is a good risk mitigation strategy. So let's look at how some of these allocations have performed in past bear markets for financial assets. This is what's called a drawdown chart. You'll notice that the y-axis shows negative numbers and zero sits at the top. What this shows is periods of loss in an investment program. So the idea is that whenever the line is at zero, your account is either equal to its highest point or making new highs. That's good. Whenever the line is below zero, that shows how much you would have been down at any given time relative to your last high. This is a great tool to show what tough times look like for an investment program. Notice that an investor in these programs would have had to sit through losses of 21 to 30% in the 1970s, 14 to 28% in the early 2000s, and 25 to 38% in 2008 during the Great Financial Crisis. Remember, these are diversified index portfolios, simply following a set of rules designed to track markets, and these portfolios are pretty standard for the industry. Not only is it very difficult to stick with an investment program when you've lost 20 to 40% of your account value, but controlling risk is important beyond the negative effects of loss on your psyche and the ability to stick with a strategy. Large investment losses at inopportune times can create chaos in your life. For the person who is soon to retire, large market losses can mean a delayed retirement. For those still working, market losses often coincide with economic weakness and layoffs and reduced business income. Having to fund living expenses from savings due to job loss or a business downturn in the face of a declining portfolio can truly stunt wealth generation. Another important reason why it makes sense to try and avoid large losses is that if you can operate from a position of strength during a bear market, opportunity abounds. When the stock market and broader economy go into a tailspin, other things can get cheap too. Houses sometimes get cheaper, businesses get cheaper. Heck, even that boat you've had your eye on might get cheaper. So if you can minimize your losses when everyone else is losing their shirt, it confers you with more opportunity. Fortunately, there are methods available to us to help mitigate downside, and we'll talk about some of those methods later on in the presentation. Since we talked about index investing's biggest weakness, large and sometimes long drawdowns or periods of loss, we'd be remiss not to cover its biggest strength. And I want to cover this not just because it's important for understanding why index investing works so well, but because this is an element that translates to what we do with the global enhanced alpha strategies as well. The biggest strength of index investing is that by indexing, we take the human element out of the equation. What do I mean by that? Well, when we commit to following a set of rules, we get out of our own way. Study after study shows that active investors, both amateur and professional alike, often fail to achieve strong investment results when they trade and invest with discretion rather than with systems. Our brains are wired for survival in groups, and the roller coaster of markets wreaks havoc on our abilities to reason. We suffer many cognitive biases that inhibit our ability to make great decisions under pressure, especially when money is involved. And that's why we say that taking the human element out of the investment process, following rules set down when you are calm and collected, is the most important strength of systematic investing. And that's a theme you'll see underlying our strategies as well. Always follow a strict set of rules, always know what you will do under a range of different scenarios, never lose your cool, always stick to the plan. This segues into the concept of enhanced indexing and the questions we asked ourselves when we designed our strategies. What if we took the best parts of index investing? We would make sure everything in our process follows a set of rules. We would diversify broadly and even further than traditional portfolios. We would access markets by using low and no cost investments and then improved upon the rules. What if we designed indices with rules not to track markets, but designed to manage risk and seek higher returns? Let's take a look at what those rules might look like, and we'll use individual stocks and specifically the S&P 500 as a starting point. Let's build our own index of stocks with our own rules and see how we can do. The first rule for our new index will be that we will only invest with the trend. What does that mean? Stocks tend to be volatile, and if we watch the day-to-day action, they often seem to chop around every which way without any clear direction. That said, if we zoom out and take averages of prices over time, we can often discern a broad trend to a stock or a stock index. Here in this chart, we have the S&P 500 along with a moving average of prices that looks back 200 days. The red and the green bars represent prices of the index, and the smooth yellow line represents the moving average. There's nothing special about a 200-day moving average or a 200-day look back. It's just a common period for a moving average, and it helps to illustrate the point. We could use any look back that we wanted to. We could look at a 50-day moving average, a 150-day moving average, a 300-day moving average. But for these purposes, we're just going to look at a 200-day look back for demonstration. We can use this moving average as a barometer of trend and construct a rule. An asset is in an uptrend if it's above its moving average, and it's in a downtrend or a sideways trend if it's below its moving average. So the first two rules for the new index will be as follows. Number one, if the price of the S&P 500 is below its moving average, we're not going to own any stocks at all. We're just going to sit in cash. On the other hand, if the price of the S&P 500 is above its moving average, we can own stocks. But which ones? The second rule is that we're not going to own any individual stocks that are trading below their respective 200-day moving averages either. So in summary, we check the market, the broad market, the S&P 500. If it's above its moving average, we can own stocks. We're going to look at the individual stocks in the index and only own those that are above their respective 200-day moving averages. So those are rules 1 and 2 of the enhanced rule set. Next, let's think about the universe. Remember, the S&P 500 is only going to look at the top 500 stocks in the US by market capitalization or size. So instead of looking at the top 500 stocks, let's expand the universe and look at all stocks that are liquid enough for us to trade. Think about the baseball player who averages 4 at-bats per game versus the player who only averages 2. Who do you think will get more hits, all else equal? Likely the player with more at-bats. A bigger universe is going to confer more opportunity than a smaller universe, all things equal. To summarize rule number 3, we're going to open up our universe and look at many more stocks than just the top 500 as ranked by market capitalization. Now we have a big universe of stocks, all trending higher, and the index is trending higher as well. How do we narrow down our list from here and pick the individual stocks that we want to own? Next, we'll look at momentum. Momentum is a measure of how stocks are moving relative to one another. The stocks that are moving up the fastest are said to exhibit strong momentum, and the stocks that are lagging have low momentum. We will rank stocks by momentum, and then we will concentrate by just owning the top 20 to 40 stocks as ranked by that momentum score. So to summarize, enhanced rule number 4 is that we're going to concentrate our portfolio and own just 20 to 40 stocks out of those that are in uptrends. And enhanced rule number 5 is that we will select the 20 to 40 stocks based on their momentum score or adjusted relative strength. Both academic and empirical research show that the momentum factor is a persistent and exploitable anomaly in financial markets. As investors looking to exploit this anomaly when conditions are favorable as indicated by our trend rules, we want to own the stocks that are showing the strongest adjusted relative strength. By ranking stocks according to this factor, we can select our concentrated portfolio of 20 to 40 stocks. So that's it. We have a handful of simple rules, and here you can see the comparison of the rule sets. On the right, we have our enhanced rule set designed for performance and risk management, and on the left, the rule set for the S&P 500, which is designed to track the performance of the large cap US stock market. Let's look at some hypothetical results comparing the two rule sets over time. First, let's look at growth over time. In this chart, we have the S&P 500 shown in red, and we have the enhanced rule set, which we call GEA equities, shown in blue. The enhanced rule set compounded at a substantially higher rate than the S&P 500 over this time frame from the years 2000 to the end of 2022. But a couple of other things stand out in this chart as well. First, and something many in the industry fail to acknowledge when they talk about index investing, is that for the investor who started investing in the year 2000 in the S&P 500, it basically took them 13 years to make any money. The painful bear markets in the early 2000s and the great financial crisis took investors down with them and delayed their financial futures. Second, for the enhanced rule set, remember how we said that we wouldn't own any stocks at all if the trend on the overall stock market was not positive? Well, we see 3 flat spots on the chart for the enhanced rule set in blue. From the years 2000 to 2004, over a period from 2008 to 2009, and again from the beginning of 2022 to the end of the year when this chart ends, where the stock market was indeed in a downtrend. So that rule kept the system in cash. Remember, in real time, we would not have needed to make a human decision about when to get in and out of the market. We wouldn't have needed to time the market with our discretion. We already specified the rules that would make that decision for us beforehand, and we got out of the market simply by following those rules as specified. Next, we have the drawdown chart. And as you can see, the enhanced rules in blue do a much better job of keeping us out of trouble relative to the S&P 500 in red. Again, this is because of our dual trend filters on both the index and individual stocks. So the enhanced rules not only enhanced returns, as we saw in the previous chart, but reduced risk as shown here. We spoke earlier about how one of the goals of an investment advisor should be to help drive outsized returns and lower risk, thereby enhancing risk adjusted returns. And this is a great example of that concept in action. I want to caveat this by saying that better rules don't guarantee you will always win. This chart again shows the enhanced rules in blue and the S&P 500 rules in red for each individual year in the time series. There are certainly going to be years when the S&P 500 rules beat the enhanced rules. In fact, in the 23-year period from the years 2000 through the end of 2022, you'll notice that the S&P 500 rule set beat our enhanced rule set on the basis of returns in 5 of those years. If you're going to achieve outsized returns over time, the simple fact is that you will need to endure periods of relative underperformance from time to time. It's just an unfortunate part of investing, and it's of utmost importance that you understand this if you're going to pursue an enhanced investing strategy. We showed how we might create a better rule set as applied to a stock index. We showed the rule set behind the S&P 500 and how with enhanced rules we could potentially earn outsized returns with less risk. But a well-diversified portfolio will own more than just US stocks. It should also own sometimes foreign stocks, domestic and foreign bonds, as well as alternatives like real estate, gold, oil, and commodities. So next, let's see if we can construct a better rule set with regards to a complete portfolio allocation. For this exercise, we will use an industry standard balanced allocation as our starting point. This is the same balanced portfolio that we saw from Right Capital earlier, and again, it's a pretty good representation of what an industry standard balanced portfolio might look like. For the industry standard portfolio, the rules are that we will own the following asset classes in the following weights, and we will rebalance the portfolio on a quarterly basis. One note before we move on, and we see this all the time from advisors using more traditional methods, is that there's very little exposure to alternative assets like real estate, gold, oil, or other commodities. And that's just one of the things we're going to want to fix when we design our new rules. Let's look at some performance data for the industry standard balanced rule set. Let's look at the same time period as we did for stocks from the year 2000 through the end of the year 2022. You'll see that the portfolio compounded at 5.2% annualized. So that's a modest return, but it did lose 28% of its value in the depths of the great financial crisis and was down over 20% at one point in 2022. We also show the Fortuna ratio here, which is a measure of risk-adjusted return. Simply put, this measure puts your return in the context of the risk it took to achieve it. A higher Fortuna ratio portfolio is generally a more efficient portfolio, meaning it has higher risk-adjusted returns. In a vacuum, the Fortuna ratio doesn't provide us with much insight, but as we'll show later, it's a very useful measure for comparing portfolios and seeing which is more efficient from a risk-adjusted standpoint. So we know the rules for the industry standard full portfolio index solution. Next, let's put together some better rules like we did for stocks. You'll notice that these rules will be similar to those that we used to design the enhanced stock portfolio. We'll start by expanding the universe. As discussed earlier, we want exposure to assets that move differently from one another, as this enhances diversification and can increase risk-adjusted returns. So we're going to open up the universe. We're going to use all the same asset classes from the balance model, plus the option to invest in gold, oil, commodities, and the potential for a heavier allocation to real estate via real estate investment trusts or REITs. Next, we'll employ a trend rule. Similar to the stock portfolio, rather than owning all assets all the time, we're only going to want to own those that are in uptrends as defined by a clear indicator. Next, we'll employ momentum. Just like with stocks, of the assets that are in an uptrend, we only want to own those with the strongest price momentum. Finally, we'll own a concentrated portfolio. Out of the universe of asset classes we evaluate, we want to check the markets once each month and only own the five that are exhibiting the strongest price momentum. Let's look at some test results, this time with the industry standard balanced portfolio from before in red, along with our new rule set, which here we just call enhanced in blue. First, in the table, you'll notice that the new rules substantially outperform the industry standard on the upside. The new rules saw an annualized return of 8.7%, while the industry standard saw a return of 5.2% annualized. Next, you'll notice in both the table and the drawdown chart that the enhanced rule set saw much lower downside as well. So the rule set did a much better job of protecting capital and mitigating losses. Finally, when we compare the Sortino ratios, you'll notice that the new rules showed risk adjusted returns almost 3 times higher than the standard rule set. Put another way, the enhanced rule set provides returns that are about 3 times higher than the standard rule set for each unit of risk an investor is willing and able to bear. So you can see how just a few simple rules designed for performance and risk management rather than market tracking can provide better results. To be clear, the rule sets we showed you here are just representative of the concepts that underlie our investment methodology. What we actually do at Fortuna when we're managing money is not quite this simple, but conceptually, it's not that much more complicated. To wrap up the discussion, let's again take a look at the strengths and weaknesses associated with traditional index investing as compared to using enhanced rule sets. Both the traditional and the enhanced rule sets are algorithmic. Therefore, if an investor can stick with either system through thick and thin, they will have successfully removed the human element from the equation. And that's a good thing. Regarding simplicity, traditional indexing definitely wins. Anyone can sign up for a robo advisor and get a traditionally diversified portfolio. That said, if you work with an investment advisor who does this for you, like Fortuna, you will not bear the extra complexity involved in deploying an enhanced strategy. That's why you pay your advisor. Regarding cost, both the enhanced and traditional methods use low cost index funds, so costs remain low across both methodologies. Regarding taxes, since the enhanced rule set does trade more actively, investing in this way will increase tax costs, but we've designed our strategies to mitigate this as much as possible. There's more information that covers this in the appendix, so take a look. To wrap the strengths, both traditional and enhanced indexing have worked well historically, but as we showed, the enhanced rules allow for an edge and a potential for better returns. As for weaknesses of traditional indexing, we saw that the enhanced rule set did a better job of mitigating downside, and we saw that the enhanced rule set had the potential to outperform. This is what we do at Fortuna. This is how we manage client assets. We gave a couple of quick examples of the type of systems that we design and the rules that we follow as we seek better returns with less risk for both our client assets and our own. The examples we gave covering enhanced rule sets for both stocks and for a complete portfolio were just that, simple examples. At Fortuna, we manage money using 3 sub portfolios: a stock based portfolio, a defensive portfolio, and an alternative portfolio. As you can see here, we use a diverse rule set for each sub portfolio, with the purpose being to diversify across signals, timeframes, assets, and asset classes. We then allocate across these 3 subportfolios, depending on each individual client's goals and risk tolerances, to create our master portfolios. Those are called GEA Standard, GEA Balanced, and GEA Conservative. For those clients looking for higher returns and willing to bear higher risk, we also have our GEA Levered portfolio and our IRA aggressive portfolio. Again, our goal in creating these strategies is to maximize returns for our clients as a function of the risk that they're willing and able to bear. So, we've talked about our investment methodology, but the proof is in the pudding. So, let's look at some real results. We launched the Global Enhanced Alpha suite of strategies live with real money in August of 2018. And below, you can see the performance of these strategies since that 2018 inception. These are all net returns. All GEA results are net of all fees, including underlying fund fees and Fortuna's management fee of 1%. So these are net results that our clients received. The benchmarks shown are unmanaged and therefore reflect no expenses. You will notice that we've outperformed conventional asset allocation models on both an absolute basis as well as a risk adjusted basis, net of all fees since inception. And as of this recording, we're coming up on 4.5 years of real time investing using these methods. So we have a 4.5 year track record of live data, but it's difficult to make investment decisions based upon such a short time frame. Below, we have a table that shows a combination of the test results of our models from 1973 through July of 2018, with our live results appended on from August of 2018 onward. Again, for both our test results and our live results, all underlying fund fees and Fortuna's management fee have been factored into the numbers. So the numbers on this slide show a combination of hypothetical and live results, net of all fees going back to the early 1970s. As demonstrated in both our live and hypothetical returns, Fortuna's rule set offers the potential for higher returns with lower risk than traditional methods, and this is evident across all metrics, including the annualized returns, the maximum drawdowns, and the measures of risk-adjusted returns, including the Sortino and the Sharpe ratios. As we wrap, we'd be remiss not to mention those that came before us. Fortuna is a research-based shop. The foundational investment methods that we employ are not new or unique to us. Rather, we've built upon the foundations that the greats built before us, put our own spin on things, and combine strategies in a unique way. At a high level, these are the concepts that underlie our research and execution, along with some of the names of the pioneers in their respective spaces. For curious minds looking to do it yourself, or for those just looking to learn more, these are some traders and investors whose research we would suggest you start with. Lastly, if you found this presentation compelling, I'd encourage you to get in touch. We pride ourselves on being open, responsive, and we'd love to hear any questions you might have, either about our investment methodology, our financial planning process, or really anything that's on your mind regarding your financial life. We'd love to help, so please reach out. Thank you.